Hello, I'm Samir Jain, founder and CEO of FinTech ActiveAllocator. Welcome to our video podcast. The term fixed income is so deeply ensconced in the investing lexicon, a Google search throws up 58 million hits, that we have stopped questioning it. I'm going to challenge conventional wisdom and argue that just because something is called fixed income, it doesn't mean it is fixed. And I can say it with some conviction, for we at ActiveAllocator have great visibility into the space as we allocate across over 2 million fixed income instruments around US ag bonds, government bonds, TIPS, short duration, long duration, investment grade corporate, high yield, munis, world ex-US, pretty much anything in government agencies, collateralized bonds, structured products. So I'm going to say that investing passively in traditional fixed income exposes investors to low expected returns. It has very little scope for capital appreciation. Moreover, in doing so, one forsakes many great opportunities because you exclude a lot of interesting niches in credit investing. So in this presentation, I'm going to advocate a new way, a way that is rooted in multiple resilient drivers of return, such as interest rates, credit spreads, illiquidity, alternative risk premia. And the idea is simple. The more the sources, the more the drivers of return, the lesser the dependence on a particular market factor, and therefore the more resilient the investing thesis. You know that abundant liquidity, low interest rates, and a very accommodative monetary stance has kept traditional fixed income returns low over the past years. We are already seeing a renewed interest in interest rate neutral strategies. The good news is deleveraging in the financial, household, and corporate sectors now seems pretty much well underway. However, the deleveraging pace and trajectory within government finances is still quite unclear. So in all of this, outperforming efficient traditional fixed income markets without taking excessive credit and interest rate risk is getting more and more difficult. And investing risks from spread, interest rate, credit widening, as well as unexpected inflation will continue to rise for the next few years. So this is going to be a challenging market for conventional fixed income investors that are looking for yield. So here's a hypothetical. If one were to create a balanced, well-diversified traditional fixed income portfolio, it would probably resemble the Barclays ARG index. Treasuries, securitized instruments, different types of corporate debt, agencies, largely investment grade. So this index or this allocation would have the return characteristics that investors have historically associated with traditional fixed income. Steady returns, low vol, moderate correlation to major asset classes, something that's been well studied for decades. So all of this sounds great, I guess, but the flip side is all of this comes with low absolute returns. There's very little scope for capital appreciation because nearly all of the return is going to come from interest income. It comes with very low risk-adjusted returns. The Sharpe ratio is extremely low. There is absolutely no illiquidity premia. As you can see, all of these securities are highly liquid. And there is significant interest rate risk, which is captured in the duration measure. Another interesting point that I came across when examining different fixed income subtypes is this huge diversity in returns. Something that might be a top performer one year may be in the lowest decile the next year. And given this huge variance every year, it becomes very hard to allocate with confidence. And also, if you see here on the right hand side, the contributions to return from taking on both interest rate and credit risk seem to vary a lot each month, and this makes it hard to figure out how much interest rate risk and credit risk one is taking. So if you peer deeper, given this degree of instability, it is exceedingly hard to build fixed income subsector exposure in a sensible, forward-looking manner. We've also seen a secular decline in interest rates over a long period, and this has propped bond markets in the past, but that's over. So, which begs the question, are there interesting pockets within fixed income? I suppose there are, but in general, one can run but not hide. If you're looking at shorter duration bonds, as many financial advisors have begun to recommend, I do not think that these solve the fixed income objective without taking on excessive credit risk, and they also offer very little value from active management after fees, as this is a fairly efficient market. But more importantly, they do not address long-term investing needs because you just can't keep rolling over shorter duration bonds. Then there are these floating rate securities whose coupons reset with increasing interest rates. I don't think they are a solution either. These are part of the high yield universe, so while they may reduce interest rate risk, they are not going to insulate investors from rising credit risk. Diversified bond holdings. These have different underlying bond maturity dates, and because of that, this creates interim price fluctuations as maturing bonds have to be necessarily liquidated at different times. Also, their NAV fluctuates daily as these are driven by daily changing market prices and not the fundamental value of a buy and hold to maturity strategy. MBS, this brings complex model risk, cash flow predictability risk, as well as what we saw in the last crisis, credit and default risk. Bank loans on the surface seem to provide relatively stable returns because their coupons are tied to rising interest rates. But what I've seen is these are becoming a part of the traded loans market, and they often suffer from buyer-seller mismatch during periods of market stress. And this creates risks of downward pricing pressure, price swings, and capital loss upon forced liquidation. Munis? Yes and no. Given deteriorating financial conditions because of largely local economy factors, a lot of muni risks too have risen. Emerging markets debt, perhaps, but I'm not too sure because liquidity risk is a critical consideration, and also a lot of these markets are not very deep, and moreover they're pretty hard to access for retail investors. So not to belabor the point or to flog a dead horse, we can see that there are many dangers in naively investing in traditional fixed income. So ask yourself if your allocation to fixed income is going to give you all of this, and I'm not going to read it, you can scroll through it. Essentially stable cash flows, low vol, low correlation, capital appreciation, an inflation hedge, which is what fixed income investing was supposed to be. I guess probably not. So our approach at ActiveAllocator to asset allocation within fixed income is not a wholesale replacement, I beg your pardon, but a new way to approach fixed income investing. One that is capable of employing an immensely broad range of markets strategies that are quite unavailable through traditional fixed income investing. So without getting into products or vehicles, think of retirement income aligned alternatives such as real estate, private debt, structured notes, perhaps even credit hedge funds. There's so much out there that can be a valuable complement to traditional fixed income investing. So in putting the allocation horse before the product cart, and this is something we feel very strongly about, we think one should build exposures of interest rates. After all, you earn a risk-free interest rate for lending money safely over short periods of time, plus a term premium for lending over longer periods of time, and that term period is rising. Credit spreads. On top of returns from interest rates, you earn an additional spread for lending with credit risk, and this excess return compensates you for the risk of default. To unlock returns from illiquidity, if you have the ability to tolerate some illiquidity, you may consider investing in illiquid, higher yielding assets and extracting a time-varying illiquidity premia. Also, the other thing we often miss is alternative risk premia. For example, long-term mutual bonds, municipal bonds, expose investors to the risk that the tax law will change, but not to interest rate risk. The idea is, again, the more the drivers of return, the more resilient your portfolio. So we suggest building fixed income exposure by unlocking fundamental exposures, skills, illiquidity, and taking on very carefully calibrated downside risk. Our approach at ActiveAllocator also helps you differentiate between cheaply accessed market exposure, or in the jargon they call it beta, versus expensive and priced skills that is based off a manager alpha. So as we reach the end of this presentation, I'd like to leave you with a few takeaways. Unlike traditional fixed income, our approach has multiple resilient drivers of return. The second point is, traditional fixed income relies on very few return sources. We build off multiple sources of return. Correlations. Traditional fixed income is all about passive beta. Our approach is about combining multiple beta sources that are extracted from multiple active managers, which cumulatively create low directional exposure to markets, in other words, low correlation. Traditional fixed income is all about playing in efficient markets with very little scope for performance differentiation. In our approach, manager skills are of great importance, and one needs to differentiate between the good, the bad, and the ugly. Our approach is not about predicting markets. In fact, we wouldn't even know how to do that. It is all about managing to markets. Of course, active allocation does come at a price because you pay for skills and outcomes, but that's good because these are aligned between managers and investors. If investors profit, managers get paid, so there is absolutely no asymmetry in payout here. So I encourage you to sign up at ActiveAllocator, where in a matter of minutes you'll be able to compare a traditional fixed income portfolio with our framework, and here you will see that the yellow risk return frontier, actually it's more than a risk return frontier because our allocation is across fundamentals, skills, illiquidity, downside risk simultaneously, but for depiction purposes one can think of it as a risk return frontier. The yellow line constructed using our method is consistently above the traditional fixed income blue line portfolio. So to summarize and conclude, ask yourself if fixed income is really fixed, go beyond products, and I hope that we can be of help at ActiveAllocator. Get in touch with us. Thank you for listening in.